This morning, while every mainstream financial outlet was focused on oil prices dropping and ceasefire headlines out of the Middle East, three completely separate structural signals fired in the silver market at the exact same time. China halted silver futures trading, not slowed it, not circuit breakered it, halted it, emergency suspension, no reopening date announced. Simultaneously, the banks that have been positioned short against silver for over a year reduced that short position to its lowest level since the beginning of 2025, the period immediately before silver ran to $120, and silver itself hit $83.17 intraday on a day that was supposed to be defined by risk on sentiment and safe haven outflows. Three signals, three independent data sources, all pointing in the same direction. On the same day. That kind of convergence is not noise, that is structure. And here is what makes today different from every other silver breakout headline you have seen this cycle. There is a fourth signal, and it is the one that the mainstream financial press has completely missed. China has banned the export of sulfuric acid starting next month. If you don't immediately understand why that matters for silver, stay with me, because by the time I explain the mechanism, you will understand something that the vast majority of investors, including experienced precious metals investors, have not yet connected. Approximately 75% of all silver produced globally does not come from silver mines. It comes as a chemical byproduct of mining copper, and sulfuric acid is the primary input in the process that extracts copper from ore. No sulfuric acid, no copper processing, no byproduct silver. China just banned the export of that chemical. The supply disruption this creates is not speculative. It is a direct, documented supply chain consequence that begins feeding through to spot markets in weeks. The silver price at $81.32 today does not reflect that disruption. It cannot, because the disruption has not yet reached the physical market. When it does, the adjustment will not be gradual. This is Recession Warnings. Today is Friday, April 17th, 2026, and what I am going to walk you through today is the most structurally significant convergence of silver signals I have covered in this channel's history. We are going to go through today's precise price data and what the intraday action is technically communicating. We are going to cover the Shanghai Futures Exchange emergency suspension in detail, what triggered it, what it reveals about Chinese inventory levels, and why it matters for global price discovery. We are going to look at the CFTC bank positioning data and why the reduction to a multi-year low is a categorically different signal than anything we have seen in this cycle. We are going to break down the sulfuric acid mechanism in plain language so that you can explain it to anyone and understand exactly how it translates to silver supply. We are going to cover the U.S.-Mexico Critical Minerals Action Plan and the specific documented language around price floors for silver. And we are going to walk through what the largest institutional banks and the most credible independent analysts in this space are now projecting for where silver goes from here. Let's start with the numbers, because the numbers today are not normal. Silver spot. As of this session, bid $81.32, ask $81.57, up $3.01 on the day. A gain of 3.85%. The intraday high reached $83.17. The intraday low was $77.70. That is a $5.47 intraday range in a single session. To put that in context, a $5 single session range in silver is the kind of price behavior you see when a market is under acute structural stress, when it is trying to find its true level in real time, and the paper and physical markets are pulling in different directions. This is not a calm, orderly rally. This is a market repricing urgently. Gold is at 4,156 bid, up 66.80, a 1.39% gain. The intraday high was 4,189.60. Both metals are moving with urgency on a day when conventional wisdom said they shouldn't be. The Middle East ceasefire narrative should have been suppressing safe haven flows. It didn't. The fact that silver and gold are surging anyway tells you the bid beneath this market is not coming from fear alone. It is coming from structural demand that has nowhere else to go. Before we go deeper into today's signals, you need the context that makes the current numbers meaningful. Before the Middle East conflict escalated, silver was trading above $96. The outbreak of war triggered a sharp fear-driven correction, demand destruction narratives, industrial slowdown concerns, risk-off selling. Silver dropped, and for several weeks the consensus was that the correction would deepen before it stabilized. It didn't stabilize because the narrative changed. It stabilized because the fundamentals never moved. Every structural factor that drove silver to $120 in January of 2026 was still intact when the war started. The Silver Institute documented structural supply deficit, confirmed for the prior year and projected to widen in 2026, did not reverse when conflict began. Industrial demand from solar manufacturing, EV production, and AI infrastructure build-out did not cease. COMEX inventory drawdowns did not stop. The war added volatility to a market with an underlying structural bid. It did not change the architecture. What we are watching today is not a recovery from a miscalculation. It is the resumption of a structural trend that was interrupted by short-term fear. And it is resuming with the bank short position at a multi-year low, the Shanghai Futures Exchange under emergency suspension, and a chemical supply chain disruption that the market has not yet begun to price in. The interruption is over. The foundation beneath what comes next is structurally stronger than what preceded the correction. Now let's look at what today's session actually communicated technically. Silver opened near the $77 to $78 range, testing a zone that has been acting as recent structural support. It pushed through $80. It accelerated through $81 and $80. It hit $83.17 before pulling back. And here is the observation that matters most. It did not fall back below $80. The level that silver pushed through on the way up held as support on the pullback. That is continuation behavior. That is not a blow-off top. That is a market that wants to go higher and is absorbing every attempt to slow it down. The broader technical picture, based on the most rigorous analysis being published in this space right now, shows silver having broken out of a consolidation triangle that formed between February and early April. The next resistance zone is $95 to $100, which corresponds to the late February peak. The zone above that is $115 to $120, the January peak resistance. Each of those is a milestone, not a ceiling. And based on the bank positioning data I'm about to show you, the structural setup for clearing both of those zones is more favorable right now than it has been at any point in the past 14 months. Now let's talk about the signal that received almost no mainstream coverage and deserves significantly more. The Shanghai Futures Exchange issued an emergency notice halting all silver futures trading, effective Thursday morning, April 16th. No reopening date was announced. This is not a fund-specific suspension or a halt in silver-linked investment products. This is China's primary industrial futures market suspending silver trading on an emergency basis with no stated timeline for resumption. You do not issue emergency trading halts when markets are functioning within normal parameters. Emergency halts are issued when pricing pressure has become so acute, when the bid for physical metal so overwhelms the paper supply available to meet it, that the exchange determines normal trading cannot continue without triggering a systemic event. The Shanghai halt is the exchange itself acknowledging that something in the silver market has broken from its prior equilibrium. Now add the inventory context. Chinese silver vault holdings currently stand at 23.3 million ounces. That number sounds significant in isolation. It is not significant in context. China is the world's largest industrial consumer of silver across solar panel manufacturing, electronics production, electric vehicles, and the semiconductor supply chain. 23.3 million ounces against that consumption rate is not a cushion. It is a countdown. And the Shanghai Futures Exchange just confirmed that the countdown is running faster than the market was positioned to handle. The second major signal comes directly from the CFTC's Commitment of Traders report, specifically from what analysts call the swap dealer net position, which represents the net positioning of the major banks in COMEX silver futures. Historically, these banks have maintained large net short positions in silver. When that short position was large, it functioned as a structural ceiling, institutional selling pressure, positioned against any sustained rally. When it contracts, that ceiling weakens. Here's where we are today. The bank net short position has been reduced to approximately 23,000 contracts. That is the lowest level since the beginning of 2025, the period immediately preceding silver's historic move to $120 in January. At 5,000 ounces per contract, 23,000 contracts represents 115 million ounces of short exposure. Compare that to the record short position that was built during last year's rally, an unprecedented level in COMEX history, and the banks held that record position while silver ran straight through $100 anyway. That was the moment this cycle broke the historical correlation. The largest institutional short in history could not stop the rally. Now that position has been more than halved from its peak, down to a multi-year low. The entities that historically functioned as the structural price ceiling are no longer positioned to act as one. Now let me walk you through the signal that is receiving the least attention relative to its consequence. China has announced a ban on sulfuric acid exports beginning next month. The ban runs through the remainder of 2026. Most people who read that headline will not connect it to silver. That disconnect between what is happening and what the market has priced in is the specific opportunity that exists right now. Let me close that gap for you with a precise explanation of the mechanism, so you understand exactly what this means for silver supply and silver price. Approximately 75% of all silver produced globally does not come from dedicated silver mines. It comes as a chemical byproduct of mining other metals, primarily copper, lead, and zinc. Copper is by far the dominant source, and sulfuric acid is the critical chemical input in the hydrometallurgical process that extracts copper from ore. In heap leach copper operations, which are the dominant processing method used across the major copper-producing regions of South America, North America, and parts of Asia, sulfuric acid is not a supplementary input. It is the extraction mechanism itself. You flood the crushed ore with an acidic solution. The acid dissolves the copper. You collect the copper-rich solution and process it into refined metal. Without sufficient sulfuric acid, that process does not slow down. It stops. And when copper extraction stops, the silver that flows as a byproduct of that extraction disappears from global supply entirely. China is the world's largest exporter of sulfuric acid. When China removes that supply from global markets starting next month, copper operations that depend on imported acid will face an immediate input shortage. They will not be able to substitute overnight. Alternative supply chains for industrial chemicals of this scale take months to years to establish. The production cuts that follow will be real, they will be measurable, and they will reduce the byproduct silver that flows into global markets. Now layer onto that what was already happening to copper production before this ban was even announced. Chile, one of the two largest copper-producing nations on Earth, reported production at a 9-year low as recently as March 31st of this year. Output was already declining before this disruption entered the equation. The supply of the metal that generates 75% of global silver was already tightening. And now the primary chemical input that drives that supply has been restricted at its largest global source. The silver supply disruption this creates is not speculative. It is not a theory built on assumptions. It is a direct, traceable, documented consequence of an export policy decision that takes effect next month. What it is not yet is priced in. Supply chain disruptions of this nature take weeks to months to feed through to physical spot markets. The commodity analysts who cover silver have not yet published models reflecting this input shock. The industrial procurement teams at solar manufacturers, EV producers, and semiconductor fabricators have not yet begun bidding aggressively for forward silver contracts to protect against the supply reduction. The mainstream financial press has not yet run the story connecting the Chinese sulfuric acid ban to silver supply. When each of those things happens, and they will happen, the market will have to reprice silver to reflect a supply picture that is materially worse than what is currently modeled. That repricing, driven by a single supply chain factor alone, will be significant. And it arrives on top of a market that was already in its 6th consecutive year of structural deficit entering 2026. The Silver Institute projects the deficit to widen to 46.3 million ounces this year. Since 2021, approximately 762 million troy ounces have been drawn from above-ground stocks. That is nearly a full year of total global mine production already consumed from reserves over 5 years. The sulfuric acid disruption does not arrive into a market with abundant cushion. It arrives into a market where the cushion has been steadily consumed for half a decade, and the deficit is projected to accelerate. The math on that does not produce a mild or gradual price adjustment when it reaches the physical market. Now let me give you the geopolitical context, because what was being reported this morning was materially different from the narrative the headlines were selling. The dominant headline was that Iran stated the Strait of Hormuz is open. Oil dropped 11%. The Dow surged. Every mainstream outlet framed it as the conflict winding down and risk receding. Here is what was simultaneously documented in the actual reporting. The U.S. Navy stopped 13 ships from passing an Iranian port blockade. President Trump publicly confirmed the U.S. blockade remains fully active until a formal peace agreement is signed. A 2-week ceasefire extension is under consideration, not agreed upon, as a mechanism to create space for negotiations. The strait is not resolved. The blockade is active, and the cascading consequences of that continued blockade are already visible and measurable across global industrial supply chains. Middle Eastern aluminum smelters, which depend on raw material imports through maritime routes that run through the contested zone, have been cutting production for weeks. Aluminum prices in London reached a 4-year high as a result. At least 19 jurisdictions globally have now imposed export restrictions on energy, fertilizers, and agricultural commodities. 9 Asian economies have implemented formal policies to reduce domestic energy consumption. Europe reportedly faces a potential jet fuel shortage within 6 weeks if the strait situation does not find resolution. None of those are silver-specific headlines, but every single one of them is part of the operating environment in which silver is being priced today. Every supply chain pressure, every export restriction, every industrial production cut increases the urgency with which governments and corporations are working to secure critical mineral supply domestically. Every government watching this situation unfold in real time is running a mental inventory of what its economy can produce within its own borders versus what it depends on fragile global supply chains to deliver. Silver is explicitly named on the United States critical minerals list. That designation is not symbolic. It reflects the determination by the federal government that silver is essential to national security, industrial production, and the clean energy transition, and that its supply cannot be treated as reliably available through normal market channels under current geopolitical conditions. The strategic implications of that designation are now being actively tested against a live disruption. The macro environment reinforces the physical supply dynamics from a completely separate direction. The Federal Reserve is in a position it has publicly acknowledged it does not want to occupy. New York Federal Reserve President John Williams stated on the record this week that the ongoing conflict is simultaneously slowing economic growth and aggravating inflation. That combination has a name: stagflation. And stagflation is historically among the most hostile environments for traditional fixed income assets and among the most favorable environments for hard assets with intrinsic industrial and monetary value. The dollar index has weakened approximately 2% since March 30th, falling from near 99. A weaker dollar is a direct mechanical tailwind for dollar-denominated commodity prices, including silver. The 10-year Treasury yield sits at 4.29%, well off prior cycle highs, as the bond market attempts to simultaneously price an economy that is decelerating and an inflation environment that remains elevated. When real yields approach zero or turn negative, meaning nominal rates are falling while inflation expectations are rising, the opportunity cost of holding non-yielding physical assets like silver and gold mathematically disappears. Silver does not pay interest. In a negative real yield environment, that characteristic is not a disadvantage. It is simply irrelevant, because the alternative of holding currency-denominated debt that is losing purchasing power in real terms has become the structurally inferior option. Now, let me walk you through what may be the single most consequential development of this entire silver cycle, and the one that has received the least coverage proportional to its importance in the precious metals community. Documents from a U.S.-Mexico Critical Minerals Action Plan, connected to Treasury Secretary Scott Bessent's recent meeting with the Mexican Secretary of Finance, outline a new framework for preferential trade in critical minerals between the two governments. Within that framework, price floors supported by additional government-backed policy instruments are explicitly described as part of the mechanism for establishing supply chain resilience. Mexico is consistently among the world's top 2 silver-producing nations. Silver is explicitly named on the United States critical minerals list. The action plan language describes the establishment of mutual supply chain resilience for named critical minerals, including silver, supported by price floors, and related intervention mechanisms designed to ensure supply stability. Consider carefully what that means for your risk calculation as an investor. If 2 sovereign governments, the largest economy in the world and the largest silver producer in the world, formally establish a minimum price for silver, a floor beneath which the price cannot fall without triggering coordinated government-level intervention, then the downside risk profile of silver as an asset changes permanently. You are no longer holding a commodity exposed to unconstrained downside in a risk-off environment. You are holding an asset with institutional price floor support being actively constructed by governments with both the motivation and the mechanism to enforce it. The floor has not been publicly announced. The action plan is in the development and near-term implementation phase, but the framework is documented in official government communications, and the intention is explicit in the language. When this transitions from action plan to active policy, and the documented language suggests that transition is being designed for near-term implementation, the silver market will need to reprice to reflect the elimination of its lower tail risk. That repricing has not happened yet because the announcement has not been made yet. Positioning before the announcement is the asymmetric opportunity the current price represents. Let me now give you the full spectrum of what the most credible voices in this market are currently publishing, so you have the complete picture. Jesse Colombo, whose technical analysis in precious metals is considered among the most rigorous in the independent research space, has published a framework pointing to $300 to $500 silver over the course of this bull market cycle. His framework requires silver to break and hold above the $95 to $100 resistance zone, and then clear the $115 to $120 resistance established at the January peak. Based on today's price action and the current bank positioning data, both of those zones are an immediate technical play. Michael Oliver, a veteran market analyst with a multi-decade track record that explicitly includes periods when he was bearish on silver and called correctly against higher prices, has stated the potential for $200 to $500 silver by this summer. The reason his targets carry weight is precisely because he is not a permanent bull. He has been wrong on direction before and acknowledged it. When he assigns a specific time frame, the track record behind that statement is real. Patrick Kareem at North Star Bad Charts has published a long-term framework pointing to $800 silver based on a 45-year trend line in the ratio of the Dow Jones Industrial Average to silver. In 1980, that ratio reached 25 to 1. Today, with the Dow near 49,000 and silver near $81, the ratio sits near 600 to 1. Historical precedent shows this ratio compresses violently when structural conditions align. The structural conditions are aligning now across multiple independent frameworks simultaneously. The institutional bank forecasts published in February 2026 form a consistent picture. Bank of America projects $135 to $139. Citigroup projects $150 to $170. Capital Markets projects $150 to $160. TD Securities projects $118. CIBC projects $150. Deutsche Bank projects $100. Every major institutional bank on that list has silver above $100 as its base case projection. The most conservative target, Deutsche Bank at $100, represents a 23% gain from today's price. The most aggressive institutional target, Citigroup at $170, represents a 109% gain from $81. These are not anonymous social media projections. These are the research departments of globally regulated banking institutions with compliance frameworks, risk committees, legal review, and reputational accountability publishing above $100 silver as base case. The bear case deserves direct treatment. A formal peace agreement signed in the Middle East would cause oil to collapse and briefly return deflation fears to the market narrative. Industrial demand projections would be revised downward on recession concerns. Silver could retrace to the $65 to $70 range and consolidate for several weeks. That is a real scenario. But here is what the bear case does not reverse. The sulfuric acid export ban remains in effect regardless of a ceasefire. Chile's copper production does not recover in a quarter. COMEX inventories do not refill overnight. The structural deficit does not disappear because geopolitical risk temporarily recedes. Even in the bear case, the structural floor is higher than it was 12 months ago. The trajectory does not reverse. It pauses. And understanding that distinction is the difference between mistaking volatility for reversal and holding through the noise toward the structure. Silver at 81.32. Today is not the reflection of a fully informed market. It is the number the paper market has produced before the sulfuric acid story reaches commodity desks, before the U.S.-Mexico price floor is formally announced, before the COMEX inventory trajectory becomes front-page financial news. The investors who understand what is being built right now will not measure their returns from $81. They will measure them from this moment when the structure was still being assembled beneath the surface, and the majority of the market was focused somewhere else entirely. This is Recession Warnings. Subscribe to this channel if you want the structural picture before it becomes consensus. That is the only edge that consistently matters in markets like this one. Stack with conviction, hold with patience, know exactly what you own and why you own it.